And we're live
Again.
again. Technicalities. Anyway, everybody, welcome back. Our next guest needs no introduction, although he's going to get one from Craig. But those of you who know him as Randy, the financial guru for Mastermind and Summit, and probably the third or fourth pod now, Randy, right?
Yeah.
Yeah.
Third,
So
fourth, fifth.
Craig, do the wind up like you did the first time.
Yeah, so Randy
failed.
is, if you ever watched the Godfather movie, there's that Irish guy, he's the consigliere of the family. I think that's like Italian for lawyer, advisor, or something like that. And Randy's been that for me in my life for over 20 years. He was the guy I called when Acme DSO wanted to buy my practice, and he said, no, don't do that. You know, dentists are people who, will never go out of business and swing for the fences and charge forward like an entrepreneur wrecking ball. So Randy has been there for me personally. I never make a move without his guidance, financial guidance. And now he just summoned us to this podcast because he got data. And Lord knows I can't look at data, but I can digest it. So he did the painstaking work to assemble the data, which you got just a couple of weeks ago, digest it, and now you have something very important that you've told your children, you've told everyone, and now you're telling the 17 million listeners on the #1 world's greatest podcast ever recorded.
Do you want to just say what it is?
I don't know what it is. I don't know what it is. I don't know what it is.
Still doesn't know.
We still don't know. So what is this, Randy?
So, what this is I'm a member of several different investment groups, and one of them is a worldwide group, 1,600 members, and representing hundreds of family offices. And every year, everybody fills out surveys, and we get the data. And I'm fascinated by finding out how the rich invest, and how the rich think about money, and how the rich manage money, and how the rich think about what they should be spending, etc. And I appreciate your intro calling me your financial guru. Wow. But what I will tell you is everything I've learned through my 40 years of entrepreneurship, building a business, selling selling it again, all the stuff, and then being a real estate investor primarily, and then also alternative investments, public equities, what have you. Like Warren Buffett used to say, is our success is not that we're better investors. Our success is that we screw up less, right? So they follow fundamentals and they try not to make stupid mistakes. And what's funny about investing is retail investors, meaning all of us, move money the wrong way at the wrong time every time. Look what's going on in the financial markets right now. I just came from lunch with 3 buddies who are, decent net worth guys. And they're all figuring out what to do with this market, right? The tariffs are hitting, stocks are tumultuous, the market's back to September levels. Do we sell? Do we hedge? Do we put a collar around our best investments? And my advice to most of them is to not react when there's market action, but to sit back and let the market do what it does. And you should only act on investing from making the right decisions, not reacting to outside market forces. And so what happened, gang, is I reached out to Peter and Craig and I said, guys, there's things going on and I have some new data and I just want to teach people how to invest like the rich. So let's do a pod. And that's why they invited me on today.
So wait, just so I get a timeline, when did you get this data? When did you say, oh shit, I see this trend, or I have something to say? When did this happen?
So markets don't, and when talking about markets, I'm talking about public markets. They don't like uncertainty, right?
Course, yeah.
So whenever there's uncertainty, there's volatility, and volatility makes people nervous because when we look at our phone and our net worth was X and now it's 10% less, we feel less wealthy and it affects our decision making. And maybe we won't buy a car this weekend when maybe we would have, and all those things.
Or maybe we'll sell our Porsche at a discount. I mean, it's using hypotheticals.
Right. And
maybe we'll ask Peter for a distribution.
Yeah. And so what I find is, for the last 5 years, I've sat on this council and I'm the co-chair of the Palm Beach group of my investment club. And everything I did in life in investing was chasing whatever the opportunity was. And it was like a wave would start building. I'd want to get on that wave. And right when I get on the wave is when it breaks on the beach.
Yeah.
Every time,
yeah.
Right? It's like once I heard about something, it was already too good. I jumped in at the tail end. Another one.
Hence the retail investor. So
yes.
The insiders are knowing, everything's priced in. Just
Yeah,
to kind of bring it down to dentist level.
Yeah. So
The street knows way before we do.
Yeah, what I want your dentist to remember is that the best way to make money is with specific knowledge, right? When you
Right.
get out of school, you know nothing. Excuse me, high school, college, whatever, you know nothing. So you're not worth anything to the business community. You know, you're worth 50 grand a year if you've got a heartbeat, right? And so then you start doing whatever it is you're doing and you get specific knowledge. And then suddenly you're more valuable to that corporation, right? And as your specific knowledge grows and you execute on that, you build and build and build. I have a friend recently who started a new business and it's making $3 million this year. He says, "Can you believe I just started a business and it's making $3 million?" I go, "It's because you've been doing it for 40 years. You know exactly what to do. You just started a new one." You know what I mean?
So you understood business, and now you're just selling a different widget.
Yes.
But business is always the same.
Yeah.
As
And
makes sense.
and investing, it's cute when I say I want to teach people to invest like the rich. The rich aren't good investors. The rich don't invest. The rich place money and people manage it. They hire managers. They have many managers. They have internal managers. They have external managers. But what happens is your dentists have specific knowledge in their business, and that's where they're going to make their highest return. So, but what happens to us when we start making money, and this happened to me in the late 90s, is I started making money over here, and then I had investable cash, right? The end of the year would come and I had 100 grand with like no place for it. I didn't owe it in taxes. I didn't, no place for it. So I now had money to invest. So then I went out and started trying to find investments. And what's funny is when your coworkers and friends and colleagues and acquaintances find out you have money to invest, boy, will they help you place it, right? Everybody has an opportunity for your money. Everybody's got a deal. Everybody's got a son-in-law who's building an app or a friend who's doing a real estate deal, whatever. And so people end up making money. Then they go put it into these bad investments they should have never done. And then usually they don't make any profit, or they lose some of their money, or they're locked up for years, or they lose it all. And then they go back to what they know how to do and they start making money doing it. So what I want your investor, what I want your dentist to do is I want them to be sophisticated investors by earning money in their business, getting as much money out of their business, as little tax due on that money, and then placing those investments into a bulletproof portfolio. And by the way, I did not copyright that. I've been saying that for 10 years. Getting it into a bulletproof portfolio.
And you're not saying a portfolio sponsored by Bulletproof. You're saying an impervious
portfolio.
I just want to make that clear because people are like, okay, here's
the pitch.
Here's the pitch.
So Peter, for fun, if you would put that slide up, the one with the pie chart.
And while Peter's doing that real quick, I want to say one thing that a lot of unsophisticated investors believe money is luck. So when they get that 100 grand, they treat it like a chip on a roulette table. Little Johnny's developing an app or something like that. So they tend to be highly risky with that money. And since you love Warren Buffett's 3 rules of investing. Number 1, don't lose your capital, don't lose your investment. Number 2, don't ignore rule number 1. Basically just capital preservation, just don't lose money. And I think intellectually, these dentists that we work with and that we're part of them, we think, okay, I made my money. It was boring. It came in $5,000 increments, and it took me a long time to build this 100 grand nest egg. Now, let me just go put a chip on the table. And they are risky, very risky. I can't believe how risky unsophisticated investors are. Sophisticated people with lots of money are far less risky than unsophisticated people with limited amounts of money, at least in my experience.
Craig, there's school teachers that have gotten rich. There's school teachers that have saved 15% of their net worth.
Oh, yeah.
And over 40 years, they've gotten $1.5 million, never making more than 50 grand a year.
Oh, yeah.
Okay. So there's a formula. There's a science to building wealth, and not messing it up is what you need to do.
Yep.
And so the most important part of this is asset allocation. And it's also known as diversification. But diversification, some people think diversification means diverse sectors within public equities. When I say diversification, I mean what different asset classes you invest in. And so this chart, for those of you listening, we've got a chart here of the largest family offices in America. and independent investors, 1,600 members, put in their asset allocations.
So these basically rich people.
And not super rich people,
Well,
just
successful people.
Successful people, right? Who are investing.
And this is what successful people are doing.
And this is what successful people are doing. So to count off this chart, 28% of their portfolio, their net worth, if you will, is in real estate. 28% is in private equity. The two of those together are 56% of their entire portfolio. One is real estate, one is private equity. None of those are public market stocks, okay? So
just double click on public markets. Public markets,
NVIDIA, Intel,
everything you can buy
Apple,
on the stock market is a public exchange.
Yeah,
that's very important. People don't know that.
Yeah. Well, most people, when you say investing, they only think about buying companies on the U.S. stock market.
Right, which are public equities.
Right. So that is part of investing. Investing is also putting a pool in your backyard. Okay, because you add value.
Or buying a new scanner for your dental practice.
Right. And so anyway, continuing on this.
Randy, give an example of private equity.
Yeah. So private equity, what that means is right now there's 3,500 companies on the New York Stock Exchange. Only 3,500, right? In the whole country, only 3,500. 15 years ago, there was 10,000. Okay, on the New York Stock Exchange. So there was a lot of opportunity of where to put your money in these companies, right? And you want to invest in companies that are hopefully growing their earnings and growing their share price, right? So what's happened is a lot of money, instead of going in and buying public company stock, they invested into private equity companies that would take a pool of capital. You as an investor give $50,000 to this company. They raise 25 million or 50 million or $1 billion, and they go out and buy the great American companies before they go public. So an example is like the business that I ran, okay? I could have sold it to a public equity company. Instead, I sold it to a private equity company. So a private firm raised money from investors and bought my company. Now, 5 years later, we've doubled the size of the company and doubled the profit, and they're now going to sell the company. So rather than individual investors buying my company and watching the stock go up, a private equity firm buys my company and then 5 years later sells it and doubles their money. In this case, they're going to make 3.5 times their money, 4 times their money. So it's just the private way to invest, and retail investors have a hard time accessing these
that's the problem.
These kind of investments. But once you get your net worth up, to $1 million, et cetera, $1.2 million, you can get access to private markets.
So a couple questions. Number one, historically, private equity outperforms the public equities. So is that true?
Yeah, that is a true statement, and there's a reason for that. Whenever we're investing in anything, if the returns are very high, usually the risk is high. If the returns are very low, the risk is low. Family offices like to invest in a broad group of assets because when I say I want you to diversify your portfolio, let's say your dentist has X amount of money in their business, X amount of money in their home. Okay, so those two things are kind of fixed. We need to live in a home. Usually we want to own it, and we run our business, right? All your other money, where is it going? Is it going into private credit? Is it going to public equities? Is it going to bonds? Is it going to alternative investments or Bitcoin or whatever? There's all these different asset classes. The purpose of having a broad mixture of asset classes is because they go up and down like a roller coaster. And if you only invest in the stock market and it has 3 great years, that's great. But when 2022 happened and the S&P 500 was down 22%, then you were down 22%. I had friends that were down 22% because all their money was in one asset class called public equities. The wealthiest people invest in multiple asset classes. I'm going to read a few more here just for clarity. Hedge funds is another way to invest money. Fixed income, call that bond income, is another way to invest money. Currencies, that would be foreign currencies. Commodities, that would be Bitcoin, gold, things like that. Cash, okay? Cash is an investment, okay? And some people say, well, because of inflation, 2 or 3 or 4%, cash is a terrible investment. Well, cash is a terrible investment compared to others, except in 2022, I would argue if you had $1 million in the stock market and $1 million in cash and the stock market went down 22%, your cash that only made 3% with a 3%, maybe it was neutral, was not a bad investment because it shielded you from more downside. Okay. So, and the purpose of having a pie chart and figuring out where you're at today and where you want to go is because by nature of having these multiple classes, they all won't go up together. One or two of these are going to be down at all times. So yes, you're not trying to pick winners. You're trying to diversify so that over time your net worth will go up slowly like a corkscrew. It won't go parabolic because you found the next NVIDIA. Okay. So, but if your returns for the years are averaging 10%, and then one of your buckets goes down 2 or 3 or 5 or 10%, not only does it not affect your net worth, it doesn't even damage your returns for the year. So a guy like me, my chart looks similar to this. I'm a little heavy.
And by the way, I just want to point out for those that are not watching, private equity, 28%, real estate, 28%, public equity is 23%. So right off the bat, you have like 85%, right? Am I doing the math almost right? 80% in those three domains. Hedge funds, fixed income, currencies, commodities, all like 1%, so like 10%. That's like a rounding error. The problem is, and I'm going to bring up my own personal story, and Peter, I'd like to hear yours. I had absolutely no access whatsoever, at least I understood I had no access to private equity until about 5 years ago. So Peter, just honestly, are you exposed in private equity? Like broad market exposure in private equity? I was not when I was your age. I could say that.
Now, yes, but I got to tell you, like 5 years ago, I didn't even know what that meant. Honestly, I didn't know what private equity meant. I was
I probably didn't know what it meant as well.
With stock market, honestly.
For the purpose of my message today, knowing how the rich invest is important. Whether you have access to it or not, you certainly have access to everything else on that chart: real estate, public equities, bonds, cash, what have you. Private equity usually has a little bit more of a hurdle. There might be a $50,000 minimum or what have you. So it may be
really. Be honest. I mean, I don't. Is 50,000 real? Can you get into private equity?
Yeah, you can get into private equity for 50,000.
Okay. I didn't realize that.
And and in fact, there's some funds being created that could even be less than that.
Okay. Interesting.
And that's the reason that you want access to all these different things and to diversify your bucket is because over time you will get good steady growth and you will never get wiped out. Let's talk about what the term wiped out means. Okay, I have friends that lived through 2001, the dot-com explosion, for those of you who remember what that was, and 2008, the great financial crisis, for those of you who remember what that was. I have PTSD from these two events, okay? And I learned a lot from them. And one thing I learned after the great financial crisis is I would be a different investor going forward. And I stopped swinging for the fences because saving my money and never going broke is the most important thing, not how much I earn in returns. Everybody on this pod probably has a business or works for a business. Now, remember when I talked about your specific knowledge? You can be a W-2 worker. I have a friend who retired with $10 million as a W-2 worker.
Mike.
He had specific knowledge. He made a lot of money for his company, and he was a good a reasonably good investor, and ended up making a lot of money. But put all that time and effort into finding a way to get your business to make another 50, 100, 200 grand a year. Don't spend all your time and energy trying to pick the next NVIDIA. You're never going to do it. If somebody could do that, they would beat the markets all the time. You guys know what a hedge fund is, right? And I'm going to explain it for the layman here. A hedge fund is simply a company that says, give us your money, we're going to put it in a fund, and we're going to go out and do some crazy stuff that doesn't track the stock market. If the stock market's going to go up, we're going to bet against it. If the stock market's going down, we're going to take the other side. They go out and they try to do wild bets that are non-correlated to the stock market. So 15 years ago, there was 3,000 hedge funds and 10% of them made a profit. Today, there are 11,000 hedge funds. 11,000 hedge funds. And you know what they are? They're full of money from retail investors and savvy managers. And the managers know how to get you to put their money there, and you're going to have bad returns in 10,000 of them or 10,500 of them, mediocre returns on some, and the top 100 are going to have good returns, but you have to write a $25 million check to get into those. So we're not getting into those anyway, right? So again, there's always somebody that'll take your money, but if your listeners would focus in their 20s, 30s, and 40s on having a certain component of cash, a certain component of digital assets, a certain component of public equities, a certain component of real estate, and on other pods we'll talk about all the different ways you can invest in real estate. Some people say, I don't have enough money to invest in real estate. I say, do you know what an ETF is? Well, sure, I know what an ETF is. Well, you can buy an ETF that only invests in apartment real estate and distributes all the profit. So you can buy one share of stock for $10. Now you're in the real estate business. Okay.
I think that's a very important part to understand, because people flock more to crypto or to Robinhood because it's the easy button.
Right.
They don't have access to it.
Right. So when you go to your person at UBS or Merrill or whoever is your wealth advisor, let's say, and you ask them for a diversified portfolio, they're going to give you a diversified portfolio of stocks. And what I would suggest is you ask them for a diversified portfolio of asset classes. Buy stock that is in the lending business. Buy stock that is in the real estate business. So you could still invest in these asset classes without going out and buying an apartment building or the duplex next to your neighborhood. Right? You can do it through the public markets. The only thing about the public markets, and the reason why the rich usually don't have more than 20% of their money. I mean, look on this chart for last year, it's 23% of the wealthiest families only have 23% of their money in the stock market. And the reason is when the market goes down 22% like it did in 2022, what happens to them? Nothing. It's 4% of their net worth. If they made 10% on their portfolio that year, it doesn't even lower their net worth. It just takes their return that year from 10 to 6 or whatever. You know what I mean? This is really important. Okay.
But I mean, it's got to be that they're these decisions to leave the equities in favor of real estate and private equity are because they have to be performance based. They're seeing better returns, I would imagine.
The public equities are priced to perfection. Okay.
So there's
everything,
no asymmetry.
everything that's knowable about a company is known, and the investors have made their bets betting on it, right? So placing their bets on it. So this isn't about public equities good or bad, real estate better than public equities. Right. I know people who have made great money in real estate and great money in public equities. But what I want you guys to do is just focus on being diversified enough that you never have a bad year, maybe never even have a down year, okay? Because what happens, Peter Boulden, when the stock market goes down 22% and the next year it goes up 22%? What happened?
It was you're still down.
You're still down because it's a markup, not a margin, right? Mm-hmm. So when people got hurt in 2008 and the market was down 40%, it took them 10 years to recover. Now, if they were a young person running a practice and they were investing, $5,000 a month or $2,500 a month, they actually invested into those gains and they did quite well. But nobody that I know with people with a lot of money would put all their eggs in public equities, mm-hmm. right? In fact, as this chart shows, they only do 23%. Now, Peter, if you want to throw up the other chart I sent you.
While we're doing that, I just want to say something too, because look, we're talking about like good, better, best. So you're talking about best in class. You're talking about the richest, most savvy people you're talking about their ideal portfolio. I think a tremendous portion of our listeners, Randy, don't invest at all. Literally cash in the mattress, don't even go into public equities. So let's talk about the guy who is literally just so fearful. He's sitting in a Capital One account at 4% or a whatever UBS account at 4%, and he's on the sidelines. So you're saying there's private equities and real estate. I would just like to have the message of like S&P 500. On the last All In podcast, they said that the Social Security Treasury has been invested in bonds, and it's now grown to $2.7 trillion. If the if the Social Security Fund had been invested in the S&P this whole time, it would be like $15 trillion. So let's talk about this person that's listening to us right now, says, oh, wow, investing sounds really scary. I know what's happening. You lost 22%. They're sitting on the sidelines. You know how many dentists I know, I look at their stuff, they're actually not even invested at all.
Mhm.
So speak to them.
So let me tell you. So one day I sold my company. So think about this. I sold my company after 35 years of work, and I had all the cash, right? And every day I would look at my phone and I'd click on the app and I wanted to see the cash. One day I called my guy at Merrill Lynch and said, what happens if I look at the app and it says zero? Like, who do I call? Could somebody steal my money? I mean, I was petrified. Okay. And then all my friends in my investment group were like, let's deploy that capital. And I'm like, no. I just want to look at it. I don't want to invest it. And one friend said, Randy, at some point you'll be fully invested and you'll be happy you were. But I understand where you're at right now. Okay. It's okay to make some money and put it in the mattress or the Capital One 4% account or whatever. Because what you've created is something that's so important that half of America just never learns. And I wish they teach it in grade school. And that is the habit of savings. Okay. If one of your listeners has 50 grand in the bank, good for them. Most people can't replace 4 flat tires. So if they were able to save their money and earn enough and not overspend, because we all know the law of the universe is when money comes rolling toward you, it wants to run away just as quickly. Yep. So I see people raise their income from 100 grand to 200 grand to 300 grand to 400 grand. And then you look at their houses and their cars and their vacations, and they went right up along with it. Mm-hmm. And then, then they're earning 500 grand and then their company downsizes, they get fired. They don't earn for 2 years and they lose everything because they didn't have the habit of savings. They always thought they were going to make money and that there would just always be abundance of money.
And that is particularly present in the dental world.
Okay, so
we are not doing well in this regard. We're amongst the worst. For some reason, we're amongst the worst.
So
we're the people that make 300
grand, 50 grand,
have a $120,000 car and a more. I mean, when you start diving into the financial, the P&Ls and the net worth of the average dentist listening to us, you would say, "Holy shit! I probably don't want to talk about this diversified stuff." It's like it is that scary. Yeah, so leave people with imagine the worst group you've ever heard of.
Yeah.
Because I have a friend who works at an they work with airline pilots, they work with veterinarians, they work with all these different people, and they're just constantly saying, "Holy smokes, your dentists are on another planet." Like they get X amount of dollars in, they're thinking about buying a boat, and they think they're going to retire in 2 years. And it's like they defy the laws of basic math. So there's something about the fact that we get to 28 years old and we've never earned a dollar. That we get out of school, we're like, I've been eating ramen noodles throughout my 20s. I deserve a Mercedes-Benz. Hey, you're making 83 grand. Yeah, but a Mercedes-Benz they'll give me money. They'll give me, 9% car loan. I'm buying that.
I get that. And I did it. I lived it. Okay.
Right.
And I'm
but
mentoring.
Not at 28, you did it at 21.
Yeah. But and now I'm mentoring people, including my 3 adult children, on the habit of savings and the discipline of increasing your savings to at least 15% eventually of what you're earning. Okay. And if you take that 15% and you invest it, and let's say for now they're investing it in cash, because that's an investment. I just proved to you that cash can be a very valuable investment, right? And everybody tells you how bad cash is. I love cash. Okay. Just a percentage of it. And the wealthiest Americans have 9% of their money in cash. Okay. So if somebody's sitting on $50,000 or $100,000 and they're deciding what to do with it, what I will tell you to start with is don't think about the $100,000. Think about what you're going to do with 10% of it. Okay. You got that 100,000. You love seeing that number in your bank account. It's 6 figures. Take 10,000 of it and then pick 2 asset classes: stocks, public equities, and maybe some public equities that focus on real estate or lending. Okay. So if they took that $10,000 and they put 3,300 into the S&P 500, 3,300 into some lending ETFs, companies that do private lending, call it like used to be a bank. Now there's all these private lenders, and you can invest in them through the stock market, on your E-Trade account or whatever. And then besides private lending, maybe 1,000 of that $10,000 goes into digital asset, Bitcoin or something like that. Not 6,000 of these coins you hear that all your friends are pumping and dumping and all that. Just the gold standard, Bitcoin, or maybe a little Ethereum. So if they took that $10,000 and they spread it 3 ways, you know what they'd have for the first time ever? If they went back to that previous chart, they would have diversified assets. Nothing's going to wipe out that 10 grand because it's diversified.
Right.
So then a couple months later, they're going to go, you know what? That feels okay. And I'm looking at it and I can see it on my phone and it's still there and it didn't go to zero. So let's do another 10,000. If they have 100,000 to invest, let's take 3 years to invest 90,000 of those dollars. The point is, if you've saved money, you've already, like, you're on top of the podium, gold star. Now you're going to become an investor, and you're never going to be a professional investor. The rich are not professional investors. We just know how to not lose.
Randy, I think what's the most important about this is just, even if someone's doesn't have the means or the aptitude right now, I think just even having a roadmap. Like, I didn't know, like I said, I just disclosed that I didn't know what a private equity was, right? And so you don't need to be fancy with your portfolio. Here's some data of family office, and family office just means when your estate or you and your family have accrued enough wealth where you need an office to manage all of your money. It's a data point that says, like, just kind of do what they're doing. Don't make it tricky. Don't think that you're going to outperform. My fatal flaw was that I thought I could pick winners and losers in a stock market. What happened with that? I lost.
I did the same thing, Peter.
I lost big time. I lost it all and then got scorned on not all, but like, I've never done well by picking these, I have some inside information kind of thing. Never do. It always ended poorly. And so looking for, and Randy, I went for more home runs probably than I should have, thinking, I got romantic about the zeros, and I wish in hindsight I had been more about the base hit, meaning the slow and steady. Here's the $10,000 diversified. Here's 333, as opposed to, hey, let me put this 10,000 in this new app or this new, apartment, complex that is coming out of the ground that wasn't there yet or something. And I wish someone did, and probably my dad did say that, like, hey, just go for base hits. But I wish I had done more base hits and not this venture capital of my own regard.
Yeah, we all have a story of going to the casino and winning and losing, and we all have a story of investing and winning and losing. The problem with investing is if you make a mistake, you're blowing your hard-earned money, and then you have to start over. Which is why it's not sexy to make money. I was going to say,
it's so boring that it almost makes you want to go the opposite way, right?
So then take that 10,000, invest it in a marketing campaign to try to make your practice make an extra 100 grand, right? Yeah. Like there's a method to the madness. Let's go to this chart for a second, just to get through this.
But double click on what you just said. That is kind of the rule that Craig and I talk about. If there's leverage left in your practice, do that before you start putting it into public and private equities and things like that.
Yeah, the returns are outstanding in your private practice.
Maximize the value of your practice first.
Yeah, there's so many people that are in, like, opening up an ice cream shop or giving their neighbor
all do it
a $20,000 loan, and they have crappy dental equipment. They don't have enough sensors to take X-rays. They're not paying for top tier talent. They don't have scanners. It's like, dummy. Like, this is the most important thing.
We all do it. I did the same thing back in 2000 when everybody was making money trading stocks. That was when day trading came out. I had a group of friends. We were all entrepreneurs, and we met at 5 o'clock every day, and we worked on stock picking from 5 to 7. If any of us had just stayed in our office for that extra 2 hours and worked on our business, we would have just been parabolically more successful than trying to think we were going to outsmart the public equity markets, right? So, Peter, on this chart that you put up, this is that same pie chart, right? It's those same asset classes, but this shows the fluctuation of the money flows from the wealthiest investors over time. So if you notice on the left side of the chart, back in 2007, private equity was nothing. It was 12%. So look at that beige box now over on the right. It's 28%, okay? And if you look at public equities way back in 2007, 28%, 31%. Then it came down after the stock market crash, and you see it never really went back up. Those, once bitten, twice shy. So the wealthiest Americans don't have more than 23% of their money in public equities, somewhere between 19 and 26 over the last, 5 or 6 years. Okay. Cash stays kind of consistent, in the, 8, 9, 10, 11% range. Public equities consistent now. Hedge funds are going down. Look at hedge funds were green back when they were hot and they were doing well and was coming out of the GFC. Now hedge funds are almost an afterthought. Okay. And so that's the fluctuation. So the wealthiest investors do move their money, right? But they don't do it as a reaction. I would advise nobody to make decisions based on the last 2 weeks in the economy and the market, right? There's times where you, in your business, don't just sit there, do something. In your investing, don't do anything, just sit there, okay? And so I have friends saying, well, Randy, aren't you worried about what's happening and aren't you whatever? No, because I'm only 14% in public equities. Now, that doesn't mean that some of my other assets aren't falling in value. There's just no ticker symbol. When I drive home at night and I hit my garage door opener, there isn't like a ticker symbol on the wall of my garage that tells me what my house is worth today. Today, it's probably worth $500,000 less than it was 6 months ago, right? Or more, but I don't make decisions on things that aren't priced right. Daily. We tend to get addicted to seeing these daily price fluctuations and we react to them. Don't react to them.
I have one question, just to use your crystal ball, because a lot of us are scared and unsure of what's going to happen. What in just Randy's prediction here, what's going to happen, most likely scenario over the next year? We're going to go through pain. We're not going to go through pain. What's your gut feeling and all the things that you're being told?
Wow, you're putting me on the spot.
I'm sorry, but we'll pull this up and tell you you're a genius.
Can I be like an analyst on CNBC?
No,
on the one hand, this could happen, and on the other hand, the other thing could happen.
What do you really think is going to happen?
I think we're going to have some short-term pain for a long-term gain.
Right, I agree with you.
Okay, that's not going to affect your dental practice.
You don't think so?
People, no, that's not going to affect your dental practice. Do people spend a little less on cosmetic care if they feel a little less wealthy? Maybe.
Yeah, because
so how can you outsell that? How do you outsell that? Do a little more marketing. Do a little more hard work. Look at your expenses. Let's look at your P&L. When the healthiest thing that happens to businesses is when they shrink.
Answer the phone better. Yeah, exactly. Answer your phone.
Answer the phone better. Like whenever my business went down 10%, I found a way to maintain my profit margin. And I just worked a little harder and did things a little better and came up with a new strategy or whatever. Trees don't grow to the sky. Market's correct.
One last question, because I know we have a hard stop. You said short-term pain. How long is this going to go for? I want to hear your prediction.
Oh,
just throw something out there. Worst case scenario, we'll highlight you when you're wrong.
I know you are going to highlight me when I'm wrong. My guess is that the balance of this year could be some pain in the stock market and
continuation of pain.
Yeah, continuation of pain. And remember, it's normal. Recessions are normal. Recessions are part of the system. You have to have them.
I understand.
I can't stand how everybody keeps asking the president or the Treasury Secretary, is there going to be a recession? First of all, they don't know. Second of all, the answer is yes. There's always going to be a recession. It's just today or not today. So for all of you who are wondering if there's going to be a recession, there will be. And then there'll be another one and another one and another one. And if you have a proper asset allocation, it does not affect you. You don't care. I don't even look at the market. I don't know what the market is doing today. I don't look because I've set my investments and they're growing over time. And every now and then I have to rebalance. Like if I buy something that goes up in value a lot, I actually sell some of it and move that money back to one of my other assets. Okay. And this is not hard to do. I'll bet you in a 2-hour webinar, I could teach you the fundamentals to make you wealthy when you retire. I don't mean like flying first class and 2 ski vacations, guys. I mean wealthy. It is a scientific system and it's not that hard. But us humans have these emotional, drivers that mess everything up, especially with investing. Now, do you want to talk about what I'm doing Friday?
Tell me.
Friday, I'm flying to Panama, where my boat is.
Can I do my best, Randy?
And I'm going to sail it to Tahiti. I'm going to be gone for 8 weeks.
Oh, wow. Good for you.
And Oprah Winfrey is coming.
No, that's a pretty good flex.
Okay, Taylor Swift is coming.
I'll take that.
You know what? I hope that everybody listening to your podcast has a goal and a dream. I did. When I was a kid and living in San Francisco, one day I said, I'm going to sail my own boat to the South Pacific. And now I am freaking doing it.
I love that. You thought of the thing and now you're freaking doing it. I love
Manifesting my dream is happening.
Randy, if you were to present again on a next pod, would it be a continuation of this, or like what would you think would be prudent as a continuation?
What I like is every time Craig and I talk, he says, remember, I want you to be simple. Don't use acronyms, and you asked a great question today. You said somebody's sitting with 50 grand in the mattress or whatever, and they're nervous to invest and, what have you. I like the idea of starting with a basic, this is what you do first, right? Let's make sure we don't have any credit card bills. Let's make sure the practice is maximized, has enough cash flow to pay its bills and, all that. And then with the excess cash, let's figure out an investment formula that is repeatable month by month by month, because what happens is it becomes addictive. And I remember the first day that I went to Charles Schwab in Boca Raton, I opened up my account and I gave them $2,000 in cash. I had sold like a motorcycle or something.
I remember where the Charles Schwab building was.
Remember that was?
Right on Glades Road.
Yeah, right on Glades.
Yeah.
And I gave them the $2,000, and then I went back to my office. The internet was relatively new, and I looked online and I saw the $2,000. And then I bought Midas muffler stock and something else that a friend told me to buy. And then like a week later, it was $2,200.
Yeah.
And I was hooked. That was it. I made $200. Every dollar that you invest is like an employee working for you.
Yeah.
Little soldier.
Every dollar you invest is like a soldier. It's an employee. And the dead dollars are the ones that you go and buy crap with that you don't need. And then like I have people who told me that swimming pool cost me $1 million. I'm like, it looks like a $25,000 pool. Yeah, but I worked for Microsoft at the time, and I sold these stock options that I had to put the pool in. And if I'd kept them today, the pool's $1 million.
That's
okay,
funny.
So
yeah, people told me about that.
Look into your garage.
It's an asset. I'm like, no, it's not an asset.
Look at your garage and look at all the stuff in there that you haven't touched in a year. You don't need. Figure out what it costs. All of that stuff could be compounding at 10%.
Yep.
Every dollar you spend
when you start looking
could
at
be
things
working
like that,
for you.
When you start looking at things like that, you never want to buy anything. Because the $100,000 portion is not just $100 grand; it's $10,000 of passive income per year. It's crazy.
Yeah,
it is absolutely crazy. And
Randy,
I just want to give my shout out to Gavin. Gavin started investing with money he earned about 3 or 4 years ago. He picked on his own Walmart and Amazon, and the reason why is everywhere we go, everywhere we travel, Walmart's always busy. And it just seems like it's a very good company. He is up at least before, like maybe a week ago, he was up like 90% in Walmart. He started investing when he was 10.
My guess is when he gets his first job, he'll absolutely be saving 10 or 15% of his money.
Yeah, he always does.
He's
literally giving me cash, and I move it over to his account all the time. He's hooked.
And working,
totally hooked.
Guys, working's fun. I worked for 40 years, and I loved every minute of it. But it's also helpful to know that you have a strategy. That no matter how your job's going, your business, your whatever, the years, the recessions, whatever, if you know that you're putting away enough to compound that's going to give you the retirement to live the life that you want to live, whether it's become a rock climber, in Sedona, or sail your boat to Tahiti, any of you can do this. It's just, you just got to follow the system.
What are you presenting on at Summit, Randy?
How to invest like the rich, just because I love the title.
So it's this essentially expanded.
It's this expanded.
Love it. All right, guys, I have to wrap. I hope everyone enjoyed.
Are you sailing somewhere too?
I am not sailing. I'm not. I don't. My childhood dreams have not come true like Randy's yet. So.
Oh, come on!
You're not old enough.
It's amazing.
Boulden, what did I tell you when we got on today? I said you look 10 years younger. What'd you do when you said I shaved?
Look at how blurry everything is.
The filter's behind me, but I'm telling you, when I shave, I get accused of the Doogie Howser, which it's good. It's good.
It's good now. Hey, Randy, I'm proud of you. Thanks for sharing the story. I'm sorry.
Thank you, Randy.
I made fun of the Oprah part of it, but I know how much selling means to you, and all those little things you've wanted to check off, like calling somebody from a noisy bar in Avalon.
That's where ones and zeros actually get exciting, because they get deployed at, like Craig, like your farm or something. When they get deployed, that's the goal. It's not just to accrue a bunch of digits on a screen.
Yes. No, it's for experiences.
That's right.
New stuff.
That's right.
I always tell people I don't love money. I love what it buys.
Damn right.
Yeah.
Damn right. All right.
Sweet. Well,
thanks, Randy. Thanks,
Thanks,
Craig.
guys.
I
Thanks,
appreciate
Pete.
you guys.
Take care.